this video class, which is going to cover IFRS 15, which is revenue from contracts with customers. So I've broken down this video class into about 4 parts. So that means you need to watch all 4 parts for you to fully understand this video class on revenue. But this is if you are in level 1. If you are in level 2, there's going to be another separate session which is going to cover the special considerations. So this video class is mainly to cover the 5-step model of revenue recognition. So let's get into it. So I want to start by looking at what your syllabus covers, which is what are you expected to be examined on when you look at revenue. So the first thing is all the areas are examinable at core level, except for the following areas. So the first one is your step number 1, which is identification of a contract. This you're only required to know at awareness level, which means you're not expected to know the deep technical of it, but should be able to explain if there is a contract with the customer based on stage number 1. Then you are also not expected to know too much of contract modification as well as contract combinations. So for those ones, you're only expected to know only at awareness level, which means you should be expected to identify if there's a modification or if there's a combination of a contract, as well as to explain what it means when we say contract modifications or contract combinations. Then for step number 2, 3, and 4, you're expected to know in detail. However, for step number 5, please note that the following are excluded. Revenue for licenses. So recognition of revenue for licenses is scoped out of the syllabus. You're not expected to know that. As well as specialized industries such as construction contracts. So for all construction contracts which are emanating from the construction industry, those are excluded from the syllabus. You're not expected to know that. So since we've covered the contents of the syllabus, let's go straight now into the expectation of IFRS 15. So we'll start with the scope. What is it that is accounted for under IFRS 15? So your IFRS 15 is commonly known as the revenue the residual standard, which basically means you do not get straight into IFRS 15, but you first make an assessment as to whether there is any other standard which covers that particular recognition or accounting for your revenue. If there is a specific standard which actually covers that, then you need to actually go and use that specific standard. For example, let's say you have got an investment that you have in a financial instrument. So your investment generates income in the form of interest or in the form of dividends. Now, there is a standard which actually covers how to account for that investment in a financial asset, which is either your IFRS 9, or you might be accounting for it as an associate in IAS 28, or you might be accounting for it as a business combination under IFRS 3 and IFRS 10, which means there is a specific standard for accounting for that, which means you do not use IFRS 15 for your interest income since there's a specific standard. Same applies. Let's say you have a lease contract, so you enter into a lease contract. Obviously, you're going to have some form of revenue from that contract, which, let's say it's an operating lease, you're going to have rentals which you're going to account for on a monthly basis or on an annual basis emanating from that contract. So since IFRS 16 specifically covers income emanating from leases or income emanating from rentals, then you are not going to account for that rental income under IFRS 15 since there is a specific standard. It also applies to your insurance contracts. So if you are in insurance, there is a specific standard which actually covers insurance or contracts emanating from an insurance, which is IFRS 4 or the IFRS 17 which recently came through. So in that case, that means no insurance contract revenue shall be accounted for under IFRS 15 since we've got a special one, which is IFRS 17. But for the rest, where you make a test and you make a conclusion that there's not any other specific standard, then you are allowed then to come into IFRS 15 as a revenue residual standard. Now let's say you are now in IFRS 15. So how do you account for revenue specifically under IFRS 15? So IFRS 15 takes you through what they call a 5-step model. So your revenue should be able to meet 5 steps for you to be able to put it into your books. And let's go through the summary of that 5-step model. So the first thing for you to be able to account for your revenue under IFRS 15 is you need to prove that you've got a contract with a customer. So when you go back to the name of the standard, it says IFRS 15 is revenue from contracts with customers, which means you need to prove, number one, if you have a contract with a customer. If there's no contract, then there is no revenue under IFRS 15. So that's the first stage, which is where it's required to be proved. Then step number 2 is, in that contract, there are certain promises which are given by the entity which is providing the goods or the services. So they make certain promises. They say, we're going to do 1, 2, 3, 4 for you. Now, when those promises, when you've got more than one promise, step 2 of IFRS 15 requires you to make an assessment as to whether those promises are not distinct in nature. In other words, if they should not be accounted for separately and not combined as one. So step number 2 is the process of testing every promise which we have as to whether we should account for it separately and not combined. Then step number 3 is basically coming up with a transaction price. So what is the value of this transaction to me? What price am I going to charge for this transaction? So how do you determine that? That's step number 3. Then step number 4. Step number 4 takes the transaction price and tries to allocate that transaction price to the number of separate performance obligations which we have identified in step number 2. So let's say, for example, in step number 2, you concluded that there are 2 promises which are there. And in step number 3, you concluded that we are promising to deliver these 2 promises for an amount of $500. Now step number 4 breaks down that $500 and tries to allocate how much of that $500 relates to promise number 1 and how much of that $500 relates to promise number 2. Once you've got each separate performance obligation having its own value or having its own transaction price, that's when you go into step number 5. So step number 5 is basically, now let's recognize that revenue in our financial records. So step number 5 is basically recognition of the revenue. So you need to test the 5-step model and pass tick on every stage. That's the only time then you then have to get into IFRS 15 and recognize the revenue. So what we're going to do in this video class for all the 4 parts of this video is we want to break down this 5-step model and attack one by one. When we say identify your contract, what exactly do we mean? So what are the things that you look out for? What is the expectation at CTA level as a student for you to achieve step number 1? Then you go to step number 2, step number 3, step number 4, until we finish off with step number 5, so that you fully understand the 5-step model and how it is examined. So let's begin with step number 1. So we said step number 1 is identify the contract with the customer. So what are the things that you need to look out for? So the first thing is identification of a contract is governed by paragraph 9 of IFRS 15. So you need to go to paragraph 9. There are conditions which have been stipulated in paragraph 9, and there are about 5 of them. So you need to meet all 5 conditions for you to say you have a contract with a customer. So when you jump to paragraph number 9, it says, an entity to account for a contract with a customer within the scope of IFRS 15D standard, when all of the following, so all of them should be ticked. And these are, the first one, the contract has to be approved. So you need to identify, you need to go back into your case study or into your scenario and identify where exactly is the contract approved and how has it been approved. So remember, if it's applied learning, we say this is applied stage. So CTA is expecting you to apply, which means you're not simply expected to just note down what the standard says, which is the contract should be approved. But you need to get into the scenario and say, what is the evidence that I have within the scenario or within the case study, which makes me say this contract has been approved. So on paragraph 9a, the standard says approval comes in different forms. So you need to actually understand the business practice. So within this business, usually in this industry, how do they approve these contracts? And paragraph 9A says your contract may actually be approved through a written signature. So people have actually signed a piece of paper. That's a form of approval. So if that is the customary business practice, then go and actually state that and say, within the case study, we can see that the contract has been approved since the customer has actually signed the contract. But sometimes you can have contracts which are approved, not by signing, but orally, where people get together, they discuss, they talk, and they reach a conclusion that we have a deal. So in that case, that means you're not going to see a piece of paper which has been signed. But through the customary business practice, people simply talk and they get to an agreement and they have a contract together. And I always give an example of, if you get into public transport these days, back in the days, they used to give you a piece of paper which they call a ticket, which resembled that you now have a contract together. You didn't have to sign for that ticket, but by exchanging money and you get that ticket, it means you are in a contract. These days, they don't even have the tickets. You simply get into the public transport, you sit there, you give them their money, and you sit. There is no transfer of piece of paper there, but you reach a common understanding that take me to where I'm going for a certain fee, which means that contract has been signed, but it has been signed either orally by talking, or it can have been actually signed by in an implied form. So by giving each other money, $1, and to get into a public transport which is going to town, there is an implied signing of the contract by the understanding that you've reached together. So in the case study, you need to identify what form of approval is there and discuss it. Then that's the first condition. Condition number 2, for you to say you have a contract, is the entity can identify each party's right with regards to the goods or services to be transferred within that contract. So does each party understand their own rights? Which means, for example, if we enter into a contract, we entered into a contract together between CAA and the students. So, can you identify the rights of each party? Let's talk about the rights of CAA in this contract. So, CAA has got a right to receive fees from the student, which is the sum of, let's say, $4,000. And then, what are the rights of the student? The student has got a right to receive lectures, but the right to write examinations, has got a right to graduate in the event that they pass. So each time, go back to the case study, identify exactly what are the rights of each of the parties, being the right of the customer as well as the right of the entity which is providing the good or the service. So you always need to discuss the rights of both parties. Then condition number 3, which is on paragraph 9C, is the entity can identify the payment terms within the contract. Now, payment terms means how much is being paid, over what period. So, how much, let's say you enter into a contract where it's a cash transaction, so it's simply $400 on day 1 or before the commencement of the contract. Those are the payment terms. When you look at the CAA payment terms, we have said we want 50% down payment, and they didn't make the rest of the payment over, let's say, over 3 months. So that's also what you need to bring out and say the payment terms which are within this contract are, on day 1, they need to pay 50%, and the rest is paid over 3 months, and the full amount which is repayable is $4,000. So you need to bring that out from the case study. Then condition number 4, which is on paragraph 19, is the contract should have commercial substance. Now I want you to really understand what commercial substance means, because you need to use the wording which is exactly in the standard. Now when you go to the standard says commercial substance involves, that is one of the following: either the risk, timing, or amount of the entity's future cash flow is expected to change as a result of the contract. So when you talk about commercial substance, you're bringing in number 1, has the risk changed from the time that you entered into this contract, or the risk related to the cash flows, or the timing or the amount. So by the virtue of me getting into this contract, there's an extra amount which I'm now expecting to receive from you, which is $4,000 for the fees. So there's going to be an increase in my cash flows. So the cash flows of the organization is changed, which means there is commercial substance. You should be able to discuss that as well during the exam. Number 5, which is the last one, is it should be probable to receive or to collect the consideration. So which means you need to be able to demonstrate why you say it is probable that the entity will be able to collect the consideration. For example, if you go to the bank and you want to take a loan, what they do first is they take you through a credit risk check, where they want to know if you will be able to repay that amount. And similar lines, when you come and register for CTA, we also want to know if you are able to pay 50% down, and also how are you going to get the rest of the 50%. Then you explain, I'm attached with an accounting firm, I go to work and stuff like that. So that's the evidence that we need to bring out to demonstrate that it is probable that we will receive the money because we've entered into this contract and we've done credit checks which reflect that this client, by accepting this client, we are saying this client will be able to pay because they are the credit checks that have shown that they're in good standing. Or we have made arrangements with the employer, and the employer said they're going to cover those payments, or they're backing those payments, which means the amount is expected to be received. So those are the 5 things that you need to demonstrate to prove that there is a contract with the customer. Okay. So remember, this is an awareness level. Awareness level means you should be able to explain, identify, and explain within a scenario. Okay. So for you to practice on this, I will need you to go through, you need to take the January 2019 ITC paper, paper 3. When you go through paper 3, there's a revenue question which is then paper 3. It has got step number 1, so you should be able to. So it's quite recent, this in 2019, that's when it was tested. Now, let's move ahead. I'd like to demonstrate what I just talked about through an example. So let's say CBA provides shopping services to customers remotely via the internet, and CBA Limited will package a customer's order and deliver for a price of $150. When a customer calls to place an order, the following processes are followed. CBA Limited describes to the customer the services it can provide and the price for those services. All telephonic conversations are recorded. Then when the customer agrees to the terms stated by CBA representatives, a payment is made over the telephone via the customer's credit card. Then after a successful payment has been made by the customer, CBA gives the customer an access code for CBA Limited's website in order to track its order. So now, do you think we have a contract here? So when you come back to this one, you need to test through all the 5 steps. Has the contract been approved? Yes, I can tell that the contract has been approved because it says here, the customer agrees to the terms stated by CBA representatives before they actually make a payment. So they actually need to say, we agree to the terms and conditions. So that's demonstration that the contract has been approved. Do the rights of each party, are they stated? Yes, I can see that CBA has got the right to receive 150, whilst the customer has got the right to receive the goods which they would have purchased online through CBA and the transportation of those goods which would have been acquired. And the payment terms, are they clear? Yes, definitely. The customer is required to pay 150 on day 1 before the commencement of the contract. Then, does the contract have any commercial substance? Definitely. By CBA receiving $150, there is a change in the timing and the value of their cash flows in their business, which means this transaction has got commercial substance. Then lastly, is it probable that CBA will receive the amount? Yes, because the customer is required to pay upfront, so it is probable that they will receive the money related to those goods. Okay. So you can see that there is demonstration now of why we say there is a contract with the customer. So that is what you'll be expected to do within an exam. Now, let's move to the next section. So since we now say we've got a contract, A contract, we've got three types of contracts. A contract may be just a single contract, or it might be combined, or it might be modified. Now let's talk about what we mean when you say single contract, combined, and modified contract. So when you get into a contract on day one, you get a single contract. Now that contract may change. So we may decide that I no longer agree with what we initially signed for. Let's vary this contract. Let's change it. So when we start changing it, we are modifying the contract. Sometimes I get into a contract today and I enter into another contract again with you, with the same person. So in that case, I've got two contracts, but I may have to combine those contracts depending on that. So we'll talk about that in those next slides. So let's start with contract modification. So when we talk about contract modification, we're talking about we've got an entity which has combined two or more contracts into one. And this is done only if I've entered into those contracts at or near the same time with the same customer or with the related party of the customer. So if I enter into a contract with you in the morning, for example, and I enter into a contract with you in the afternoon, then that's when we talk about should we be combining these contracts. So you will combine those contracts if certain conditions have been met, which are on the previous slide. So you just need to check for those conditions for you to say, should I be combining those contracts? So remember, for you to combine the contracts, you're looking at number one, if I entered into the contract at or near the same time, if I entered into the contract with the same person or a related party of that same person, and does the contract, for example, it resemble the same commercial substance, okay, which means ideally it is the same thing. Okay, so you look at the conditions which are on the previous slide. Now, let's put it in a small example. So let's say a supplier enters into two contracts in the same week with a manufacturer. So look at this, it's one contract. It's two contracts within 1 week, which means in a short space of time or near the same time, with a manufacturer, which means with one person. So in this case, we then assess, are these contracts two different contracts, or this is simply one contract which we need to combine? So let's say the first contract says it's to construct a manufacturer, a tool for the manufacturer, and the second contract is to supply the manufacturer with parts for using the tool. So the supplier will cover its cost for the tool from the manufacturer. So when you look at those conditions for you to either to combine, talks about does these contracts have the same commercial substance with the same commercial reasons. Okay, so you've entered into the two contracts to do one thing, or does the contract depend on the other? Does the pricing of one contract depend on the pricing of the other? So in that case, that means this is basically one contract. So when you look at this, these guys have entered into a contract where they say, can you make me a tool? Once you finish making me a tool, I'll enter into the contract where I say, now make me inventory using that tool that you've made. Which means the second contract is basing on the first contract. And now when you look at the amounts, the supplier will recover only the cost to the tool, which means prepare me the manufacturing equipment, but you're not going to make a profit out of it. You will make your profit out of the inventory that you start producing using that equipment. So you can actually see that this is basically one contract. It's a contract to manufacture a tool and then make me inventory using that tool. So we then combine those contracts into one. Alright, then let's jump into contract modifications. So contract modifications basically is saying you are changing the terms of the contract from how they were from the very beginning. So when we talk about contract modification, we're talking about you might be changing the scope of the work, what needs to be done, or you might be changing the price of what was supposed to be done. So the moment you change those terms, either the work to be done or the pricing, then you are modifying the contract. Now the biggest question is, if you do modify a contract, subsequent to that modification, do we have two contracts or we still remain with one contract? Okay, so there's a test which you need to do. And the standard says an entity shall account for the contract modification as a separate contract only. So you separate it. It means it's no longer that old contract. You need to do away with the old contract. then now I've got a new contract that I have. And that will only happen if both of the following conditions have been met, which is number one, we have changed two things. Both the scope of the contract has changed, which means the work to be done is actually changed. And number two, the price of the contract has also changed. So if you change both the scope and the price, what it means is that old contract ceases to exist, and this new contract is the one which now overrides. But if you're only changing one, which is basically if you're changing the price only or you're changing the scope only one has changed, then that means the old contract still exists. There's no new contract to talk about. Okay. So I'll need you to do example number 2, which is in your module. Example number 2 is simply just trying to demonstrate whether you've got 2 or more contracts. Okay. So that's basically step number 1, ladies and gentlemen, which is basically, can you identify a contract within IFRS 15? So what I'm going to do is when we come back now to part 2 of this video, part 2 will assume that you already have proved that there is an existing contract. Now let's talk now about how should we account for that contract that we've identified.